Hello, and welcome to a video for Grade 12 Essential Math on Manitoba mortgage rules. I wanted to take a brief video and talk about some of the rules that you'll experience if you're purchasing a house in Manitoba. These are specific to Manitoba. Also, this is important that this information is current as of August of 2020 when I made this video. This is useful, but depending on your situation, this might change if you go to a different province, or over the years, this might actually change. But this is good information now. Also, there's obviously more details because I can't cover everything right now. Let's take a look at the general rules for a mortgage in Manitoba. In Manitoba, you need to have a GDSR below 32%. We looked at GDSR in the last video. We can talk about how to calculate that. The banks say that you need to have a GDSR below 32% in order to afford your mortgage. Now, it's important to note 32% is the number recommended by the Canada Mortgage and Housing Corporation. However, it's not a legal limit. Some banks may offer higher limits, 32, 35, or I've seen 39%, depending on your situation and depending on your province, because some provinces have much more expensive houses. However, as a recommendation, if your GDSR is at or near 32%, you should very strongly consider a cheaper house because that is a very expensive house for your budget. 32% is tricky to afford for a house where we live. Your total debt service ratio, or TDSR, needs to be below 40%. That's the CMHC recommendation. Again, other banks may use slightly higher rates, but the TDSR is your gross debt service ratio, but also includes any other debt, such as car loans or credit cards or student loans. Now, your down payment needs to be at least 5% of the purchase price of the house. The purchase price of the house in Manitoba is over $250,000 on average for a house now, which means that you need quite a lot of money saved up as a down payment. Now, this 5% is if you're purchasing a house that's less than $500,000. If you're over $500,000, you need more money as a down payment. If you're over $1 million, you need even more money as a down payment. However, house prices in Manitoba haven't gotten that crazy yet. Your amortization period has a 25 years as your maximum length. That 25 years is the maximum length for a high ratio mortgage where you have less than 20% as a down payment. If you have more than that, you can extend your mortgage to 35 years as of 2020, but that will cost you more in the long run. It means your monthly payments are lower, but it'll cost you a lot more interest. You need to have 1.5% of your house price saved up for closing costs. That's in order to qualify for CMHC mortgage insurance. 3 to 4% is realistic. That's more realistic for what you should have saved up for your closing costs. Mortgage insurance, if you have a high ratio mortgage, less than 20% as a down payment, then you need to have mortgage insurance. The banks will require that. And that is something that you'll have to pay for. A lender may also require you to have enough life insurance to cover the cost of the mortgage. Maybe something you can purchase through the bank, or if you have separate life insurance, that may work. But if you die, they want your life insurance to be able to pay off the mortgage. That's not a hard and fast rule, but some lenders, some banks will require that of you. I'll toss some sources for this, some good information and places that you can find this information in the description of this video. But these are, as I said, these are general rules. If you're purchasing your first house in Manitoba, these will typically be the rules that you're looking for. If you want more detail, again, check out those links because I can't cover absolutely everything here. But I hope this helps. Have a great day.